Hello, this is Meetum Television exploring United States stocks. It's time for blue chip United States stock analysis. In this segment, I explain good companies listed in the United States as well as early stage companies that are growing one by one based on data. I structure this segment around 4 questions. I show you based on data whether it's a promising company, what the expected future performance is, what the current valuation looks like, and what the momentum is. These 4 aspects. So sometimes you talk about a company's risks and things like that, but here's how I see it. There's no company without risks. But when does risk really stand out? When the stock price falls, the risks become very prominent, and when the stock price rises, it often seems like those risks have disappeared. That's because the media reports it that way. What we really need to think about is that if the risk is already known to the market, it's likely already reflected in the stock price. And it's also very important to consider whether the stock price has fallen enough to fully reflect that risk. So there's no company without risk, and it's important to judge whether that risk will continue to push the stock price down in the future, or if the current level of decline in the stock price has already fully reflected the risk. The risks of this company are already well known in the market, and if they are risks that have already been reported in the news a lot, I think it's very important to make those kinds of judgments. So, just because we're analyzing blue chip stocks doesn't mean we're recommending you to buy them right now. It's more about how systems are making judgments based on data, and some of these judgments will be wrong and some will be right. Because even the best analysts, when they recommend 10 stocks, can only get about 6 or 7 of them right at most. I don't think it's much different just because it's a system. By continuously accumulating success rates, an overall cumulative ranking is created. Our blue chip stock analysis segment isn't a recommendation to buy. When investing, some companies will rise and others will fall. It's not that the ones that fell had more risk. Sometimes we can just be wrong. So please keep that in mind as you watch this segment. I think it will help you with practical aspects like how to analyze data and what to do with it. The company we're going to cover today is called Dutch Brothers. People in Korea might not be familiar with it, but those in the United States may know about it. It's a company that mainly sells custom beverages through drive-thrus. So you see here it's called Dutch Bros. Of course, they sell coffee too, but it's not a company where coffee is the main focus. If you look at the recent stock price trend of this company, the fluctuations are quite significant. Even just looking at the fluctuations over the past year, the stock price soared 222% from the 52-week low, then dropped sharply by 45% toward the end of the year, nearly halving. After that, it recovered again, showing this kind of trend, so the stock price volatility is quite high. Even when looking at the same company, some people bought here and are still at a loss, while others bought earlier, held on through this adjustment period and have different experiences. So, depending on what decision you make during the period when this stock is moving, your results can be very different. I think it's good to keep this in mind. So, even with blue chip stocks, there can be times when the stock price is cut in half, and I think you have no choice but to decide for yourself from what perspective and at what timing you will enter. To summarize this company for you, they offer custom beverages mainly through drive-through service. If you look at this picture, this is one of their custom drinks. So it's not a company that mainly sells coffee, and coffee doesn't actually make up a large portion of their sales. This company started out as a pushcart business in 1992 and is now a rapidly growing food and beverage service company in the food and beverage industry. So if you look at the growth rate, it's quite fast. And this company offers custom beverages rather than traditional coffee, mainly selling energy drinks based on Blue Level and adding various syrups for customers. They sell drinks that look very visually appealing and delicious. They primarily run drive-through stores, targeting people in their 20s and 30s, which fuels their growth. However, the company has some drawbacks. There are 2 main risks, broadly speaking. First, their focus on drive-through stores limits customer accessibility to some extent. There aren't many stores in city centers or similar areas yet, so if they expand into those locations, there will definitely be concerns about rent and the burden of operating stores. So in terms of accessibility, there are some relative disadvantages. That's the downside. The second point is that custom drinks themselves are very high in sugar, and since they're mostly high-calorie drinks, they're quite far from the health and wellness trend. So if these aspects become too prominent, it could hurt the business. That's the position of producing energy drinks. Recently, there was an article about McDonald's a few days ago. Usually when there's a recession or consumption drops, fast food tends to sell well, but even McDonald's isn't recovering well. The reason is that it doesn't fit well with the health trend, and that's an issue that's been coming up in the news. In the case of Dutch Bros, it doesn't exactly fit the well-being trend either, but it's growing rapidly with custom drinks that cater to the tastes of young people. These are the kinds of risks that exist in this situation. So it's considered an early-stage growth stock, and depending on which aspects are highlighted, the stock price could drop sharply, or on the other hand, continue to rise steadily. I think it falls into that type of company. So it would be good to take a look at the rest of the data as well. Is it a blue chip company? If you look at that question, since this company scores 55 points right now, it's not an outstanding blue chip stock. It is in the top 31% of all companies. If you look at this chart, its future growth potential is 85 points, so you can consider it a high growth stock. It also has strong financial stability and a decent ability to generate cash. As for profitability and things like that, it means the margin rate is still low. So as you can see here, companies that appear in this triangular shape are the ones I mentioned as growth stocks, and this company is showing exactly that pattern. The overall score has remained relatively stable over the past year. So I can say that this company still needs to improve in areas like profitability and monopoly, which are the parts that need to be filled in for this shape. Based on the coastal production standard, which means the sum of the last 12 months, you can see that it has been steadily growing. So sales and profits have been steadily growing, but compared to that, the net profit is currently showing quite a large gap. Now, this gap shouldn't be this big, but the fact that the difference has consistently been large means that it's likely to continue like this in the future. The operating profit margin on the right is 8.2%, while the net profit margin is 3.2%. It's quite a big difference to see it as just non-operating losses, and the fact that these losses continue steadily means it's likely to keep happening in the future. That's how you should see it. I'll explain what this is a little later. For comparison, Starbucks' operating profit margin is 14.1%, which has also decreased significantly recently. Even though it has decreased, the margin rate is still 14.1%, so compared to Dutch Bros' 8.2%, it has a much higher profit margin. So in the case of Dutch Bros, there are areas where they need to raise their operating profit margin a bit more, but what's even more important is how they will improve their low net profit margin. This seems to be a very important point in evaluating Dutch Bros. In the case of Starbucks, I'll move to the side in a bit and talk about it by comparing it with Dutch Bros as a whole. If you look at this company's inventory turnover days, although it's not particularly high recently, the fact that it's going down means that products are selling well. That's how we can interpret it. Next, if you look at cash activities, operating activities are positive, investing activities are negative, and then if you look at financing activities, it's still above zero, so it's positive here. It's about to turn negative now, but for growth stocks, it's common to see positive, negative, and then positive numbers. When financing activities are positive, it means the company is raising funds. Whether raising funds through borrowing or issuing new shares, companies are securing cash for investing activities. What do you think these investing activities might be? If a company wants to open new stores to grow, they'll need to invest in tangible assets, and those store investments are necessary, right? The company's operating cash flow is insufficient to fund investments, so they rely on other sources. This suggests that financing activities may soon turn negative. Going forward, if the pace of store expansion stays about the same as it is now, it's likely that soon the cash flow generated from operating activities alone will be enough to cover it. That's how we can interpret this. If you look at Dutch Bros' balance sheet here, the total assets are $2.7 billion, and out of that $1.4 billion is property, plant and equipment. That means it's more than half of the total assets. So in the end, the most important asset for this company is its property, plant and equipment, and these tangible assets inevitably have to be used for expanding the number of stores. So the company is raising money and investing most of it in the growth of property, plant and equipment, and for the small shortfall, they're covering it through cash flow from financing activities. That's how we can interpret it right now. Next, I'll also take a look at the income statement for you. The projected performance shows rapid growth in the stock price earnings per share, coinciding with a period of soaring stock prices as seen earlier. And then it dropped by 50% again, and now it's recovering. The stock price will follow the direction of the rising earnings per share, but for it to keep moving at this pace, the earnings per share growth rate shouldn't slow down in the future. However, if this growth rate decreases, the stock price growth rate will inevitably drop significantly in line with the earnings per share growth rate. So it moves in that direction. The best moments were actually when the stock price plummeted like this, because the long-term trend is upward, so those times would have been the best opportunities. The valuation would have been good at that time as well, so it's highly likely that the future trend will go in this direction. However, if the valuation is high, the expected return could be low. So I think it's important to determine whether the stock price is high or low and find the right point to buy. Our Choice Stock app, which lets you access all these services, has already been released. It's available on both Google Android and the Apple App Store. So if you search for Choice Stock and download it, you can see all this information. This year's projected sales are $1.58 billion, a 23% increase, $1.96 billion, and $2.38 billion the following year. If you look at the annual average, it's growing by more than 20%. So just looking at the growth rate, you can say it's a pretty good and high growth rate. The company's earnings per share growth rate is 72% this year, indicating high growth. Next year, it's projected at 48%, which is still favorable. The year after next, it drops to about 17%. So I think it's really important to watch how the growth rate changes from then on. Currently, the stock price doesn't reflect 2027 numbers. The price will move based on 2025 and 2026 growth rates. It's better to evaluate the valuation accordingly and determine your investment points based on that. Looking at the valuation, there were instances when the stock price fell sharply before. If you look here, there was a yellow section and there were times when it kept trading in a very undervalued range. I mentioned that the stock price is ultimately a shadow that follows the earnings per share growth rate and earnings per share, but the stock price can't stay in a very undervalued state forever. After the earnings surprise came out and the stock price rose, it jumped up quickly to this point. Now, once again, this area is very undervalued, but now it's come up and is trading at about a fair value level. So you can see that this company, which was previously very undervalued, has now risen to a fair value. However, due to the smaller market cap, the stock's volatility is approximately 1/8 to 1/10 of Starbucks, to my knowledge. As a result, the market capitalization changes rapidly, making the stock price quite volatile. If a correction occurs, the stock price can drop significantly. Conversely, if it rises, the increase can be substantial. Thus, it can be considered a company with high volatility. If you look at the stock price momentum analysis, there was a buy signal around May recently. So on the exponential moving average chart, a buy signal appears. All of this is visible if you enter through twist 2. For the short term, we compare the 5, 20, and 60-day moving averages. For the midterm, pressing the button draws the 21, 61, and 121 EMAs. As of now, in terms of supply and demand, it has a very good outlook. That's how we can see it. Now, I'll move to the website and talk to you a bit using actual data. Dutch Bros. For Dutch Bros, the system gave a buy signal at $64 and it's since gone up about 10%. Previously, we bought at $34 and sold at $58, a 70% gain. So overall, if you look at the cumulative returns from following these trading signals, it's about 107%. You could say this was one of the stocks where the signals worked really well. Next, if you look at the valuation here, it's currently trading from very undervalued to undervalued, and then it comes back up to a fair value level. So in terms of valuation, it's not in a very burdensome situation. If you click on the trading signals, you'll see that a buy signal appeared here because it was considered cheap. The part where there was a buy and sell signal was when the price dropped and the signal detected it, so it cuts off in the middle. It cuts off and waits, then gives a buy signal again when a clear signal appears, and now it's up about 10% in this way. So a buy signal doesn't appear just because the stock price is low. There has to be some change in the supply and demand for a buy signal to appear. Even if it's a good company, a complete supply and demand breakdown can temporarily disable the system's signals. This advantage of the trading system's signals helps reduce potential additional losses. So, though I think it would be helpful for you to refer to these stocks when you make your decisions. Now, since you've already seen the stock analysis, I'll skip that part and just talk about the income statement I mentioned earlier. If you go into the financials and check the data by quarter, you can see that this company has been consistently generating operating profit. And the operating profit is steady, even on a quarterly basis, but there's quite a big difference compared to the net profit. Then if you look here, you can see two reasons for this. Usually if the company makes about $30 million in profit per quarter, there should be at least about $20 million or more in net profit. But compared to that, the net profit is actually quite low. The reason for that, if you look, is one is financial costs. Since the unit here is 7, that's $7 million. The $7 million in financial costs is basically just interest expenses. Why do interest expenses occur? They happen because of borrowings. So if you look down here, you can see the borrowings. The borrowings keep increasing like this. And this money is ultimately what creates the interest expenses. It looks like the borrowings might stop increasing after a few more quarters. Because it seems like they'll reach a point where they can invest in tangible assets using cash from operating activities. Then I don't think the interest expenses will increase significantly. And since these interest expenses fluctuate according to market interest rates, there's a possibility they'll decrease as rates go down. But in any case, financial costs will inevitably continue. Next, among the non-operating profits, since this is all negative, it must all be losses, right? This keeps occurring. But what this actually refers to is not the non-operating side, but the net income attributable to controlling interests, which I mentioned briefly at the beginning. So you need to use the net income attributable to controlling interests for valuation and to calculate earnings per share. But in the case of Deutsche Börse, there is profit attributable to non-controlling interests, not controlling interests. So that part took out about $7 million. So the operating profit shown here is the net profit attributable to non-controlling interests. So usually the net profit is the sum of these two. So it will probably show as $22 million, of which $7.1 million is net profit attributable to non-controlling interests. So it's not Dutch Brobus's. You have to subtract the part controlled by others. Only then can you check the profit that belongs solely to Dutch Bros's shareholders. Usually, for most American companies, the difference in amounts isn't this big, but Dutch Bros is a bit of a unique case. So you can see that this kind of case is likely to keep happening in the future. This may continue until non-controlling interests are resolved, but financial costs could vary slightly based on changes in borrowings. So the difference between operating profit and net profit will probably be inevitable in the future as well. But as you saw earlier, in terms of earnings per share, so the earnings per share value that comes out of earnings per share is calculated only based on the controlling interest's net profit anyway, so you don't need to separate it out and calculate it again. So just focus on understanding that this part is about growth. And as I explained earlier, I told you how to find and interpret the parts where there were big differences, so you can make your judgment based on that. There are always news and articles coming out about this, so please refer to them. Then, by judging the risks of the company and other factors, I hope this video will help you discover some good stocks. Please subscribe, like, support, and comment if you found this helpful. Thanks!